Hello traders and welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today, August 14th, 2025, we're putting the spotlight on PUSD, a pair that has seen some exciting developments thanks to recent economic data. Just yesterday, news broke of upbeat second quarter GDP data from the UK, which initially spurred an upswing in the pound. Reports indicated that sterling was resuming its challenge towards the crucial 1.36 level, reflecting optimism in the British economy. However, this bullish sentiment was quickly met by counterforces from across the Atlantic. A recent spike in the U.S. Producer Price Index ignited U.S. dollar strength, causing PUSD to pull back towards the 1.3552 area. This creates a fascinating dynamic, a strong pound driven by domestic growth versus a strengthening dollar on inflationary concerns. The big question currently echoing across the market is whether this dollar strength, triggered by PPI, can truly last, or if sterling's underlying momentum will prevail. Let's shift our focus to the charts and see how these fundamental drivers are reflected in price action. Starting with the one-day chart, we can observe the broader trajectory of PUSD over the past year and a half. From a low around 1.25 in early April 2024, the pair experienced fluctuations before a significant downtrend took hold, pushing it to lows near 1.22 in January 2025. This dip around the 1.22 level served as a strong long-term support, initiating a remarkable reversal that has defined the trend for much of 2025. Since January, PUSD has been in a clear and consistent uptrend, steadily climbing higher and breaking through successive resistance levels. This long-term bullish bias suggests a fundamental shift in market perception for the pair, likely driven by improving UK economic prospects and a possibly softening long-term view on the dollar prior to the recent PPI data. The current price, sitting at 1.3583, represents a significant gain from those January lows, now testing levels last seen in late May 2025. Now, let's zoom in on the more immediate price action using the 15-minute chart to capture the recent volatility and the interplay of the news events. Looking specifically at the price movements from August 11th through August 13th, we can clearly see the resumed upswing mentioned in the news. After consolidating around the 1.34 to 1.345 range on August 11th, the pair started a steady climb. On August 12th, we saw a noticeable push higher, with price moving from roughly 1.343 to a peak near 1.3524. Following this, there was a minor pullback and consolidation phase, which could correspond to the initial market reaction to the US PPI spike, pushing the price towards the reported 1.3552 level, which it then surpassed. However, the significant takeaway is the strong continuation on August 13th, as sterling powered through that 1.3552 level and closed strongly at 1.3583. This move indicates that the bullish sentiment from the UK GDP data appears to have overshadowed the bearish pressure from the US PPI, at least in the very short term. The current candle on the 15-minute chart shows that buying pressure remains strong, with a close near the day's high. This sustained momentum suggests that traders are actively pushing for a retest and potential breakout above the 1.36 psychological barrier. So, what are the key price levels to watch going forward? Immediately, the 1.36 level stands as critical resistance. It's a significant psychological barrier and has been a ceiling for sterling as per recent news. A clear break and sustained close above 1.36 on higher volume would signal strong bullish continuation, potentially opening the path towards 1.37 or even higher. On the downside, immediate support can be found around the 1.3552 level, which was the reported pullback point after the US PPI data. If this level fails to hold, the next significant support would be around the 1.348 to 1.350 range, which acted as a support zone in the 15-minute chart's recent past. Further down, the daily chart indicates stronger support around 1.34, representing a key level from earlier in the current uptrend. For short-term traders, watching how the price reacts to the 1.36 area on the 15-minute and 1-hour charts will be paramount. A strong rejection with bearish candlestick patterns at 1.36 could prompt a quick sell-off back towards the immediate support levels. Conversely, aggressive buying pushing the price beyond 1.36 with conviction would be a strong long signal. Medium-term traders should keep an eye on the 1.34 level. A break below this could signal a deeper correction in the current uptrend. On the bullish side, sustained trade above 1.36 would confirm the continuation of the multi-month uptrend, targeting higher resistance zones. In terms of bullish sentiment, the strong UK Q2 GDP data provides a solid fundamental underpinning. The market's ability to absorb the US PPI shock and quickly resume its upward trajectory is also a bullish sign, indicating resilient demand for sterling. The consistent higher highs and higher lows on the daily chart since January 2025 reinforce this medium-term bullish outlook. However, reasons to be bearish or cautious include the persistent strength of the US dollar, particularly if the PPI spike signals broader inflationary pressures leading to more hawkish Fed policy. The 1.36 level itself is a significant hurdle. Previous attempts to break it might have failed, creating strong seller presence there. A failure to sustain above 1.36 could easily lead to a short-term reversal, especially if accompanied by increased bearish volume. In the short term, if we see a clear candle close above 1.36 on the 15-minute or 1-hour chart, that would reinforce a bullish trade. For a bearish entry, look for a strong rejection at 1.36, perhaps a bearish engulfing pattern or a large wick, followed by a break below 1.3552. Long-term, the bullish outlook remains intact as long as the price holds above the 1.32 to 1.33 region, which served as a critical resistance turned support in earlier 2025. Conversely, a sustained break below 1.32 could signal a broader trend reversal and a shift to a bearish long-term outlook. Traders should also look for upcoming economic releases, particularly more inflation data or central bank statements from both the UK and US, as these will heavily influence future price movements. To recap, the crucial level for GBPUSD right now is the 1.36 psychological and technical resistance. A break above 1.36 is highly likely, around 70% chance, if the bullish momentum from UK GDP persists and is not fundamentally undermined by further strong US data. Conditions reinforcing this likelihood would be sustained buying volume and further positive sentiment on UK economic growth or any signs of softening in US inflation concerns. On the other hand, a rejection at 1.36, potentially leading to a pullback towards 1.3552 or 1.348, has a moderate likelihood, around 50% chance, given the recent US PPI strength. Conditions for this include persistent USD strength, a lack of follow-through buying from sterling bulls, or a negative surprise from upcoming UK data. Beyond 1.36, the next key resistance could be around 1.37, while strong support levels are identified at 1.3552, 1.348, and notably, the 1.32 to 1.33 area on the daily chart. Keep a close watch on future inflation reports, central bank speeches, and overall market sentiment, as these will be key in determining if sterling can finally conquer the 1.36 hurdle. Thank you for watching Explain the Charts, and happy trading!